Yo, what's up?
How are you
Yo,
guys doing? Welcome
Good, chilling.
to another Sunday webinar. Let's get this started. Um, I think quite a fair bit of things to cover today. So definitely, ask me questions and definitely be a part of it. So let's get this done. So I think there are some structural shifts and trends this week within the market itself. We broke out from some key technical levels in the S&P 500 and Nasdaq. If you were to look at the daily chart here of the S&P 500, we're now above and made new highs, signaling a further push to the upside. We don't trade against the trend; we always trade with the trend. Lucky for us, we haven't been abnormally short on anything. In fact, we've been putting money towards momentum stocks and stocks that are commanding higher risk, which may possibly play out. We haven't really put anything into other swings that will kind of push when the market goes higher. Majority of my money has been tied up with speculative companies, which are more than likely to pay handsomely based on our risk analysis, right? However, I do see some structural changes this week, and I'll be waiting for a pullback to cut some hedges that I've been holding. We didn't get the pullback last week. This was a very weak pullback, therefore I didn't cut it. But on the next pullback, when we do pull down, and if we do sell off abruptly, then I will cut the hedges and let any long positions that I have running. Okay. So this week's overarching market trend sees a couple of different things happening at the same time. And my focus is primarily on the narrative that is driving the market right now. The narrative that is driving the market about, how risk is becoming a acceptable component of our market structure. I think after the GME and AMC kind of sorry, let me just mute. Okay. After the AMC and GME pump and everything else pumping, I think it's come to a point where market participants are okay with taking on risk. Now, obviously, markets are allocations of capital to the most patient, to the most impatient, right? And so when we're looking at how this capital has been allocated, I feel like this is just the beginning. When a new fad starts, it usually accelerates pretty quickly. It's just like, the first phase. And then it comes back down, and then people are like, wait a minute, there's more, I see this going to happen consistently more now in a bid and an effort to just genuinely, try to destabilize the market. And even though the long-term approach of the market will always bring fundamental value down, which means to say stocks will always seek their fundamental valuation in the longest term, these market fads in the short term may cause some exuberance. This is my point. My point being that the short-term exuberance may cause a volatile pricing structure for certain equities. Now, why are equities the choice here? Well, people are not going to put their money into bonds. Bond rates have still been increasing. So just a little bit of an update here. Bond rates are still increasing, which means to say risk appetite is still very strong with equities. Okay. And we've been tracking this for a while, right? We bought hedges. Why? Because we wanted to protect ourselves against any downside position, right? And at any given point of time, our hedges are hedging, right? For my portfolio over here, the reason why majority of my positions and my portfolio can keep growing is because anytime a drop happens, we're protected, right? We're protected against it. And so you pay a little bit of money for your insurance so that your portfolio doesn't go through wild swings. If you realize this portfolio has grown very consistently, right? We have been on a very strong uptrend with this portfolio. And we don't see any one of these, right? Like this. We don't see this. So to keep volatility low, you need to create a business structure for your portfolio where you're paying for insurance and you're keeping those downsides tapered off. And that's what we've been doing with our QQQ and TLT. And we'll be waiting for a wave down in the market and then a wave up on bonds to close those out, right? We don't want to close them out right now. We'll hold them. We have a lot of time on them. This is the reason why the contracts themselves didn't get completely destroyed. Is because we have time on them. That's the reason why I buy a little further out hedge, so that I don't need to worry about the time value decaying extremely quickly, right? In fact, we still have maybe, I want to say, 2 weeks before these really start decaying, right? 2 to 3 weeks till the end of February, right? And then the end of February, then the time decay starts to kick in, right? And with TLT, okay, we're down 56%, but this is a very small hedge. We only took 4 contracts and represents a very small percentage of the portfolio, right? So just to generalize the reasons to hedge, we need to understand that everybody's taking risk on right now. The markets are saturated, and up till, I want to say, 2 weeks ago, I was in a belief that we may be overheating, but actually, I don't think we are. In fact, some things that have just, some things keep changing. And I was doing more research this week, and, also hearing from other analysts that I know of, friends that I know of that are traders. And, there are some important points brought to the table from both sides. So I'll bring it to your attention. And, you can be the decider on your own. You can decide for yourself. What do you think? Do you think valuations are stretching too far? Or do you think valuations are fine the way they are and they can go higher? I think right now we are not too stretched, but we are getting stretched. There will be some kind of a minor pullback, but remember, I said it this year already, the 10% corrections are over. Don't expect those anymore. The maximum you get are those smaller 3%, 5%, which are dips on the uptrend, right? On the 4 hours, stuff like that, right? Like these kinds of drops, they're pretty common, down to the 150s, maybe stretching out to the 200s. It's possible, but they're not going to happen very often. Okay, they're not going to happen very often. I think that, but at the same time, I do believe that the market's only going to chug up like very high single digits this year, right? Because last year we had a really good year, and the year prior we had a pretty good year too. And so it's like that double-digit growth cannot sustain completely. Okay. Even what's happening is people are pricing in a recovery. The market's already priced in a couple of things right now. Let me try to break it down for you. The market has priced in a stimulus package. The market has priced in growth and recovery after the COVID crisis. The market has priced in interest rates being low for a long time. Okay. There are a whole bunch of things that are already priced in right now. Okay. So when everything's priced in, and then something changes, that's what causes the big fall. All right, that's what causes the big fall. But if nothing changes, and the only person that can really mess this up or really cause the market to shift downward is the Fed. All right, if they say, "Hey, our rates are getting unstable, we need to start doing something," or inflation's getting out of hand, we need to pull back rates. That is one way that could destabilize the market. But is that probably going to happen? Chances of it are very low. This Fed has been very, very dovish. Okay, very dovish. And so at the same time, there are arguments that it probably won't happen and the market will keep chugging along. Okay. The S&P 500 dividend yield just got released for January. And so the previous month, you remember we've been tracking this, right? It was 1.55 and now it's 1.57. So, okay, not as good as we were expecting, but not as bad as we were expecting. I don't even know. This is like a moment. Like, okay, it's 1.57. That's literally 2 basis. No, not even 2 basis points. It's literally like 0.02% higher than the previous month. That means earnings of the entire S&P 500 for the dividends, okay, dividends, companies paying dividends paid out only 0.02% more than the previous month. Okay, that's fine. You know, not really such a big shift. So the main topic of this week's webinar is going to be equity risk premium, which is the reason why markets are chugging along. As you know, when the Fed keeps interest rates low, the real rates are literally negative, right? As you can see from our previous weekly report, which we put out, this one right here, we were talking about how inflation expectations are creeping higher, right? And as inflation expectations creep higher, what does that mean? That means the real rate on bonds creep into negative, right? See, we're already in the negative territory, which means to say, what does that mean? That means that when we are looking at these real rates, right, the rate of return on bonds itself is negative, okay, because of the nominal rate, which is creeping higher, right? So if inflation gets higher, then the return on bonds are lower, right? And the real yield for the 10-year treasury now is now negative. So basically, you wouldn't really get any money for holding these bonds, okay? You're in fact, you're paying money to hold government bonds at this point, okay? This is the reason why people are saying, or investors are running away from bonds and they're chasing equities, because the risk premium. And so what is the equity risk premium? This is something that we we calculate in finance. It's part of the CAP-M model, okay? Let me get my pad real quick so I can explain this to you guys a little bit. The CAP-M model is the capital asset pricing model. And this is a model that we use to, calculate the return of the real return on a expected asset, okay? And the CAP-M model is something like RA. I think it's RA is the risk-free rate plus the beta multiplied by the risk of the market minus the risk-free rate. Yep, this is what it is. And so this is your expected return on an investment, okay? Expected return. Okay, and this is your risk-free rate. What is a risk-free rate? The risk-free rate is what we always use the 10-year bond as. A risk-free rate means the rate of return on a riskless asset. The riskless asset that we always use is a 10-year treasury bond from the US Central Bank, okay? So that risk-free rate, okay? And then this is obviously the beta of the stock that you are talking about, the beta. So the riskiness of that stock, and RM is going to be your expected return on the market, okay? So the market return there. And so when you get this entire equation net out, you get your basically the CAP-M, which is the return on that, expected return on that asset or the instrument or whatever, okay? So right now, the return on equities are much higher than they would be in a typical scenario. So because the risk-free rates are so low, people are chasing risky assets. And I think it will continue to be the trend until we see appetite for bonds, okay? We saw some possibility of it happening, but then it fizzled away. And so sometimes it's always better, to be there before it happens, and sometimes it's always better to be there after it happens. This time around, we were there before it happens, but sometimes it's not going to always work out in that favor, right? Okay. So the risk-free rate of assets right now, bonds right now, are pretty much crazy low, right? Okay, and that's not something that is very enticing for investors to go and chase, right? Would you want to pay the government to borrow their bonds? No. You want the government to pay you for borrowing money, right? So nobody wants these right now. It's like an investment that is not really worth it. So they say, if I'm going to put into bonds and I'm not going to get any money, why don't I put into something that will generate me money? And that happens to be stocks right now. That happens to be any other financial instrument except for bonds, right? So people shift their risk between bonds and stocks, and this is what happens in the market dynamics in the long run. So this is one thing that you need to keep into account, take into account. So market probably continues to chug along higher because of this fact. This is one side of it that I, not really. It's not really about not looking at it, but it's just it's something that you have to also keep track of. So I'm gonna actually go ahead and bookmark this page so that we don't lose track of this kind of information. So in a economy like that, or in a stock market that is performing in these kinds of expectations, we have to look at two specific kinds of sectors. Remember that at this point, technology companies and cyclical companies will be the ones that will pretty much create majority of the excess return. Okay. When I say cyclical companies, I mean your airlines, cruise lines, hotels, restaurants, tech companies, banks, manufacturing companies, um, yeah, car companies. Okay, those will be the ones that are cyclical and we should be looking at. So we can see a couple of things. Airline sector, you can look at Jets ETF, see that they've been on a very, very, very strong rebound this week, right? And we may get a pullback to actually get into this one. But obviously, you can also individually go and take their stocks, right? As for your retail and all that, we already have positions in Walmart and your Target, right? Also strong rebounds here. Target with the pullback and now looking to make another run up, right? Target also kind of like in this. We came down, we hit our target. We came down and hit our target on target. And now we are looking to move back up, right? And you can see we're kind of like in a really nice ascending pennant here. We'll see if Target can break out of this today, this week. So the main focus here is looking at cyclicals and thinking about what you want to put your money into this week, okay? And we'll look again once, obviously the team will create a sniper list out of this for you guys so that you don't have to do all the work. And, looking at hotels. So LVS saw a lot of bullish buying recently, and we saw the gap up, break above, and we were thinking, this might be an opportunistic time to perhaps take this to the upside. This might be one of the cyclical stocks, and then you also have MGM Grand, right? Also made a huge move up after a breakout. These are all key sectors that are moving. EAT, which is Brinker International, the ones that own Maggiano's and whatnot, right? These might be also possibilities, right? Consumer services, restaurants, right? MACD, cyclical once again. Starbucks, pretty cyclical, saw a huge run up this past week. And then, of course, you have big tech, and that's pretty much your MAGAF stocks, right? Microsoft, Amazon, Apple, Netflix, Google, Facebook, the main cyclicals, right? And then banks. So we look at JP Morgan, which, I was actually contemplating taking last week, but then it moved up too quickly and I couldn't catch it. Morgan Stanley, also moving. right? Nicely consolidating in this uptrend. They're all looking really great. Okay. And then, obviously manufacturing, you can look at Caterpillar. Boeing might take a little bit of time to recover, but once this one runs, this one's going to run. Lockheed Martin, this is another one we like long-term, right? Undervalued stock. And then not to mention Chinese stocks, right? Chinese stocks. So do not miss out on the Chinese stock run, right? This is another one. A lot of them showing great valuations and abilities for them to break up. So once again, the key focus of this week's trading style is risk. Is you can take some risk, but just don't go crazy, obviously, right? The main sectors to focus on will be cyclicals and technology, the ones that I've just mentioned across, right? All of them looking great. Wait for pullbacks and enter on dips rather than entering on rallies, right? This is the main thing you need to figure out. More on the pre-market update later during our live stream. We'll have a live stream later tonight as well. So yeah, just in the effort to keep this webinar short and sweet. Do you guys have any questions? Anyone have any questions? Oh yes, also for Theta Gang, people who are trading those selling premium strategies. Here are your weekly high IV picks. Your GameStop, your VIR, GP, Mara, iRobot, Workhorse, Fubo, Space, Riot, and Enox. The weekly implied movement for these are pretty high. So you could look at these possibilities for selling premium against. I will be holding my position in CCIV for the foreseeable future and wait for those premiums to crush so that I can more than likely take a 40-50% profit on the take a 40-50% profit on these $50 puts and close them out. Don't run the risk of assignment, and then see where CCIV goes after that. I may just choose to hold all of these until expiry and then get assigned the shares at a very small cost basis. So there's a lot of different things that I will decide to do during the course of the next few weeks with CCIV. I put some opportunity alerts on the technicals. Momo was one of them, highlighted by one of our members. There's a whole bunch of these that are kind of moving in a ascending pattern with gap fills, and they're mostly also cyclicals. So keep an eye on them. We'll put them on the watch list as well, the snipe list, and we'll trade them when the market opens today, hopefully. All right, awesome. Does anybody have questions? Anybody want to say anything? I'm gonna end the webinar here so that the people on the internet can tune in next Monday for you guys, and have a good week. Happy trading.